Good morning, good afternoon, and good evening, wherever you are in the world. My name is Sonia Kelly from the Center for Financial Inclusion, and I'm very pleased to welcome you to our webinar on financial inclusion and pension inclusion. We're going to be discussing lessons learned on access, usage, and financial capability. We have a lot of ground to cover in just a short time, and we have some very high-level speakers that have joined us today, and so I'm going to jump right into it and not give a long explanation of this topic. I'm going to let our speakers do that for us. But before I turn to them, let me go ahead and put up a poll on the screen so we can better understand who we're talking with today. On the screen here, and it asks, which of these categories best describes you? Are you somebody who self-identifies as being from the government or the public sector, private sector, a development organization, an academia or a think tank, or something else? Go ahead and make that selection. Looks like about half of you have been able to make a selection there. I apologize if we don't have categories that cover everybody here. We only had we have a limited limited number that we can put in here in the software, but all right, great. It looks like almost all of you have been able to select that. So we're going to close the poll and let's look at who we're talking with today, because it will help us to focus our conversation. So it looks like we have a lot of people from development organizations, about half of you, followed by the private sector. 17% of you self-identify as being in another kind of institution that we haven't captured here in our categories. So we'll look forward to hearing some of that when we get to the discussion. But this is really helpful for us to keep in mind. Let's put up one more poll that asks about where the focus of your work is geographically in the world. So not necessarily where you're sitting right now, but where the focus of your work is. Again, I recognize that these categories are not completely inclusive, and I'm sorry about that. But you can select one of the following: Asia and the Pacific, Sub-Saharan Africa, Latin America and the Caribbean, global, or other. Looks like most of you have voted now, so let's go ahead and close that poll. And we have we don't have a majority who are focused on any one region, which is really nice. We have a lot of people who are focused globally, which is great because we will be discussing things from around the world today. 25% from Sub-Saharan Africa, or 25% focused on Sub-Saharan Africa, 19% focused on Asia and the Pacific, and 6% focused on Latin America and the Caribbean. So again, this is very helpful as we frame our discussion. Just a few housekeeping notes from me. We've muted all of you who are on the line for the presentation, but we really look forward to calling on you individually. To do that, if we can go to the next slide, let me put up a picture of the technology here. So you can do this in one of two ways. There's a little hand icon that you can see in your menu bar there. You can click that, and that will essentially virtually raise your hand, and our staff here will be able to message you and call on you and unmute you. We want to have you as part of the discussion, so please make use of that. And then on the right part of the screen, you can see there's a box under the questions drop down, and you can type your question in there, and your question will be received by us and will be circulated to our speakers today so that they can be aware of that and can tailor the discussion to the things that you want to know. Any questions that we don't get to during the presentations, we will go ahead and ask at the end. And we can also follow up with you afterwards and send your question to one of our speakers so that you can start a personal conversation. So again, thank you for coming. Welcome to the webinar on financial inclusion and pension inclusion. Let me go ahead and turn it over to Susy Cheston and Elisabeth Rhyne. They were co-authors on a chapter. Oh, I'm so sorry. That's not true. Susy Cheston and Elisabeth Rhyne, you're going to have to wait a little bit of time for, because we want to first give you some context on pension inclusion. And I'm going to go ahead and introduce Gautam Bhardwaj. He's an Ashoka Fellow and has over 2 decades of experience working extensively with governments, regulators, mainstream financial institutions, and think tanks across several countries on policy formation, system design, and implementation of inclusive pension programs. And you can see why Ashoka chose him as a fellow, because of his broad expertise and deep subject knowledge. Most notably, I think, for me, is Gautam pioneered the concept of micro-pensions about a decade ago, and established a social enterprise that was focused exclusively on assisting financially excluded low-income individuals in accumulating micro-savings for their old age. I just thought this was one of the most amazing innovations that I had seen when I first came across it about 5 years ago. He has led several World Bank, ADB, and UNDP projects related to pension inclusion, and has served on several Government of India committees on postal, pension, tax, and financial sector reforms. He's currently, in addition to being an Ashoka Fellow, advising the Indian Ministry of Finance and India's pension regulator on building a mass market for India's national pension scheme among the working poor under a World Bank technical assistance. So welcome, Gautam. I'm going to turn it over to you, and you can let us know here in the office in DC when you want us to advance your slide.
Thank you so much, Sonia. I really appreciate the introduction, and it's wonderful to be here on this seminar with a great bunch of people from all over the world, and really appreciate the center for taking the initiative and hosting this. And it's great to have Susy and Beth, Rhyne, and Will Price on this panel. Very quickly, what I thought was I'll just give you a brief background, and I think it could set some sort of a context to what we're going to be discussing going forward. If I can have the next slide, please. Yeah, so basically we started working in India, as Sonia said, about a decade ago, and we found that the pension coverage gap in India was very significant. And as you can see from this slide, the gap is actually very significant across almost all developing countries that you can see on this slide. And the numbers are actually, frankly, quite staggering. On average, what we've been seeing is that the pension coverage seems to be, or pension provision seems to be restricted to people in salaried employment, people who work in large firms or in the public sector. But most developing countries, including the countries in this list, they tend to face a very significant informal labor market, and as a result, including in countries like India, most of the population is self-employed, and the concept of an employer really, or the concept of formal contractual relationships with an employer, does not really exist. And as a result, most of the population, and on average about 90% of the population across developing countries, continues to be excluded from formal pension provisions. Next slide, please. Now, so what this did was, at an aggregate level, I mean, even if you look at a disaggregated level, each country is actually facing a very large pension coverage gap. But when you aggregate this, then you're looking at about a couple of billion people who are excluded from pensions, and within that, about 1.2 billion people who are actually as part of the active workforce across Asia, Africa, and Latin America, who are excluded from formal pension provisions. Now, I don't have to tell this group that this is a big challenge, purely because unless this population is actively saving for themselves, they are likely to face a very significant period of poverty when they are unable to work. And this is something that we are seeing not only in Asia, but quite a lot as we work more and more in Africa, that people are living much longer, and family support is somehow not really something they can rely on, and children don't seem to be the best portfolio for retirement security. So as a result, you're finding that most of the populations who are excluded are, unless something is done, would face a significant period of poverty, especially in their older years. Now, normally what we've seen is countries which have large tax coverage tend to then use tax revenues to pay pensions to the current elderly who might be destitute. Now, unfortunately, the size of the problem is such, and the the, the scale of the problem is such that the fiscal cost of providing a tax-funded old age pension to people for most developing countries actually doesn't seem to be a sustainable policy option. And it's partly because of the size of the excluded workforce, but equally because of the size of the workforce or size of the population which is in the tax bracket. So in India, for instance, while we have about 400 million people who are currently excluded from pensions, the size of the tax-paying population is barely 40 million. So the numbers just don't add up. And as a result, this is not necessarily a solution which works for the elderly. Now, fiscal transfers, if they're not an option, uh, the and we did some. If you see on this slide, we did some simulations, and if you looked at the current cohort of people who will be elderly by say 2050, if even $1 a day of a pension was to be provided to them, that's a $500 billion of pension payments that have to be generated from tax revenues for across developing countries. But on the other hand, even if a very small, contribution is made by the people who are currently excluded, this can actually result in a significant corpus or pool of long-term stable savings that can be generated and which can then flow to economic development and to building, infrastructure and so on and so forth. In India, which launched pension reforms about a decade ago, we have now about, I think, about 25 million people who are in a contributions-based pension program. And within a decade, and we've just about scratched the surface. I mean, considering that the coverage gap is 400 million, and we are only at about maybe 3 or 4% of the coverage gap. But even then, we've been able to generate about 2.2 trillion rupees of long-term savings, which within a very, very short period of time. So I think if we don't do something, I think that doesn't seem to be a sustainable option. If we try to do something using fiscal resources, again, doesn't seem to be something that most countries will be able to afford. The only other option really is for people who are currently excluded is to set aside some small savings for themselves when they are young, and then to use those savings as a way to mitigate the longevity risk. Next slide, please. Now, so what we felt, and this is based on our experience in working in different countries, what we feel is that most countries seem to have a lot of you, in fact, a lot of the people who are on this seminar perhaps have contributed to building digital financial inclusion infrastructure in a lot of the countries that we're talking about. So what I think the countries could do is, broadly we see three strategies. One, build inclusive digital marketplaces where we leverage things like national ID or digital payments and other aspects of financial inclusion, including outreach through microfinance firms or banks and so on and so forth, to provide a sort of create a very convenient, secure, and affordable mechanism by which people are able to access long-term savings provisions, including and maybe insurance and so on and so forth. The second thing that countries can do is to design attractive product solutions where at least some countries like India, for instance, are well placed to harness, let's say, the securities markets that already exist, and high quality fund management capabilities and well regulated insurance firms to develop a product solution which actually works for low income people, and which can then deliver positive real returns, which can generate risk management tools which can not only mitigate the risk of longevity, but also a range of other life cycle issues that citizens face. And the third, I think, once you've designed a marketplace and you've designed an architecture and a mechanism by which people can save, and you've created an attractive and a useful product basket, then I think the only thing that is left is for countries to sort of put both feet on the accelerator and start to encourage thrift and self-help in a perhaps in a voluntary mode to a large extent, but wherever possible, maybe mandatory way. But to encourage thrift and self-help for old age, uh, and this we think could be done partly by doing financial literacy and by creating greater awareness about the need to save for old age. But equally, there could be some fiscal tools like co-contributions or matching contributions that can be used to sort of motivate people to join a program, to motivate persistency of savings, and also, I guess, to a certain extent, to sort of add on to the contributions that lower income people might be making. And we've seen that a lot of countries now are moving in this direction of fiscal incentives. And I think it's partly because there is also more, I mean, if you look at it from just a parity perspective, then the higher income people are already getting tax incentives, and governments are incurring, expenditure on account of foregone tax revenues. So from that point of view, it's more equitable for governments to incur some fiscal expenditure to generate or to motivate similarly long-term savings behavior by using fiscal resources. Could we have a next slide, please? So when we think about setting up inclusive infrastructure for digital pensions, what we looked at was where do various countries stand, and we've done a fairly extensive study, and this is just a small sort of I think maybe a simplistic view, but if you look at it, most countries have almost all of these parameters in place, and I think barring perhaps the last one, which is a dedicated team or a dedicated mission office, which is specifically focused on coverage expansion, most countries seem to already have what it takes to achieve or to establish inclusive pension programs. Now, next, please. Now, since most of the building blocks already seem to exist, what we found when we were doing work in India, and when we launched this micro pension program, finally, I think the program ended up with it actually ended up reaching out to about 2.1 million individuals across the country in India. But what we found was that while the building blocks exist in most countries, there were three challenges. One was that these building blocks don't sort of come together as a very simple or secure or as a convenient single window interface. So if I am a street vendor, or if I'm a head loader, or I'm a domestic help in a particular country, and I want to save for myself for my old age, even with good policy intent and good regulatory oversight, the pieces don't seem to come together, and none of the ecosystem players see pension inclusion as their core. So digital payment guys are very happy to come together and say, we are happy to work with you on contributions collection and do it in a very secure way where there's no error or there's no risk of fraud or theft. And we are equally happy to use digital payments to deliver benefits, but they don't see pensions as their core. So they are an integral part of the solution, but they're not the solution. So what we found was that many of these pieces that we saw on the previous slide actually need to come together as a single window, simple and easy solution, which then a person based anywhere in the country should be able to use and very easily use for accumulating savings as and when their income's allowed for their old age. So one we found was that these are not, the pieces don't come together. And I think in that context, we started thinking more and more about how technology can be a glue which can bind the financial inclusion, the ecosystem, and create, therefore, help to create an inclusive arrangement or an inclusive mechanism for retirement savings for excluded workers. And that's when we started developing this pension in a box white label platform. which actually serves as the glue. Can we have the next slide, please? The next one. The next slide, please. So we found there were three parts. One was, like I was saying, that technology, and you need technology to bring these tools together, to bring the solutions together as an integrated single window interface for low income or for excluded workers. The second we found was that most countries have different departments and different ministries and different regulators who are responsible for different things. And there was a need we found for a group to be created which, with a single-minded focus, worked only on one issue, which is not only in bringing the pieces together as a solution, but thereafter to then work extensively on achieving coverage. And in that context, there was a need to create, what we call a mission office or a PMU, and we've done that to a certain extent in India when we launched the micro pension program in 2005-06. But we now are doing that a little more in a more organized way for, let's say, the government of Rwanda, where we've set up a mission office, which is specifically looking at bringing all the pieces together into a single window solution. And then the mission office is focused entirely on actually achieving coverage. So you have a bunch of people who don't do anything except jump out of bed every morning and think about how to get to the 5 or 6 or 10 million people who might be excluded from pensions in a particular country. Now, the challenge here was, and that's where I think the book came about, and that's where we started thinking about this, which is that if you think about these two solutions, we found that a lot of the countries were either in a situation where they had already started some process for reform, but were not necessarily achieving good traction on coverage. But there were a much larger base of countries who had not actively started thinking about these issues. And that's when we met, coincidentally, we met with Will Price. And we were fortunate to be working with Will on a project in India. And that's when we started flirting with Will and saying, okay, I think, how can we work together in creating greater awareness among the policy community in this issue? And between Will Price, Parul, and I, we came up with this idea that let's actually put together, get policymakers and regulators and domain experts from different countries. Can we bring them together somehow on a common platform? And can we get them to share ideas, experiences, and so on and so forth? So that not only are they able to learn from, what's really, really cool and exciting, which is happening in the financial inclusion space, but also learn from, what the experiences of different countries have been in creating inclusive pension programs, and to what extent have countries succeeded, and what the lessons from those successes are, and to what extent countries have made mistakes. And again, how can we as new countries who are walking the same path avoid repeating the same mistakes? So the idea was to really think about how to create a community which can come together and exchange ideas, information, and views. And that's when we came up with this book project. And I mean, I think between Will, Parul, and I, it was just a matter of, we made, I think, as Will loves to say, we made 43 calls and 42 people instantly accepted and said, yes, we would love to participate in this project. And we had about 22 countries who came together and said, yes, let's work on this project together. And we published this book called Saving the Next Billion, from Old Age Poverty, Global Lessons for Local Action. And interestingly, the way Will and Parul and I had sort of about a year ago, it was just a mad idea, but today this is I think a 3-kilogram book which seems to have been published. We released this at a global meeting in DC late last year, and we had about 30 countries who came and participated in the consultation. And we're now seeing many countries are now sort of again reaching back and saying, okay, we've had a great conversation, and how can we now go to a tier 2 level discussion. And that's where we are now working with, between Will, Parul, and I. We're trying to figure out how we can create more dialogues which are more regional, but instead of only at a policy level, can we get into the nuts and bolts of doing this? And so as things stand, we're working in a bunch of countries in South Asia and Africa. But I think the scope of assisting and supporting digital pension inclusion is huge. And I think most of the people on this, in this conference or in this webinar, are people who are very well placed to support this initiative and are in the mainstream parts of different key aspects of this program.
Thanks so much. Thanks so much, Gautam. And I would love to save this list of places you're going and dates for the roadshow till the end of the webinar as well, because I'm sure some of our listeners will be interested in joining some of those conversations. And certainly saving the next billion from old age poverty is an audacious goal, but I love how you are working on the nuts and bolts and the details of how to make that a reality. I think that's fabulous. Thinking about that challenge, I'd love to turn now to Susy, Cheston, and Elisabeth Rhyne, co-authors on a chapter of that book, talking about where pension inclusion and financial inclusion fit. Susy Cheston is a financial inclusion consultant, and while she has been working closely with us and with the Institute of International Finance this past year on the topic of inclusive insurance, we're very aware that she has other clients and she assists other institutions across the financial inclusion space. Over the past 25 years in this space, she's held positions with institutions such as CFI, World Vision, and Opportunity International, among others. Elisabeth Rhyne, her co-author, is the managing director for the Center for Financial Inclusion at Acción, focusing broadly on the drivers of and the results of inclusive finance. I won't give Elisabeth a long introduction because I know she's known by many of you on the call, and Susy's going to be the lead presenter. So Susy, I'll turn it over to you.
Thank you. Actually, Beth is going to start us off with the overview.
Oh, okay. Sorry about that. So I just want to say to Gautam that it has really been a pleasure and a privilege to be part of this project and part of the book. And we were really asked, Susy and I were asked to participate, I think, because we had the financial inclusion perspective and were able to bring in the questions about what have we learned from financial inclusion that is relevant here. And so I think that could kind of be summarized in the question of really, we've got this challenge of people who need to save for their older age, and how do we make that happen? And we really wanted to focus on the question of how people, what would it take to get people to contribute to voluntary pensions? And I'll just start with thinking about the fact that what we have seen in the research that we've done on aging is that, for one thing, people use a variety of tools when they're older. They're patching together various strategies for livelihood. And currently, as Gautam described, contributing to a pension is not really one of them, although people do have, when you ask them when they're in their 60s, you ask them how do they think they're going to pay for their lives when they're older. Many of them say, oh, it's going to be my savings. And but then when you look at what's actually happening, the savings turn out to not be adequate, and people are more likely to be relying on government subsidies and on family support. So we think that there is a role for contributory pensions. It's a question of how to make it happen. And so if we want to take this question seriously, I think this question hasn't been taken seriously in the past because it's just been assumed that enormous swath of people wouldn't be able to contribute to their pensions. But I think now we can assume that there are some reasons to believe that is possible. And the first one is that the technology exists. The fact that we can now have payments B2B, B2C, C2B, C to government, all those different ways of paying are now possible and cheap enough so that even if a person is making a tiny contribution, the payment can be handled cost effectively. But I also, one of the things that I've definitely learned as a result of participating in this project is that if this is going to work, what has to happen is that the funds that are collected need to be managed over a very long period of time, and they need to be managed together with funds from higher income people so that there is a general pension management process going on. The cost of managing funds is a significant portion of the overall cost of pensions, and if you were to have standalone pensions for people in the lower income group, it would be very hard for the contributions to cover the costs. The arithmetic just wouldn't work out, but it would work out if there is a trustworthy place, and the trustworthy is important as well, in that people are not going to want to put their very long-term savings into institutions if there's any question about the stability of those institutions. So I've come to the conclusion that this really needs to be public-private partnerships, that situations like Mexico and India, where there are government pensions with private players who help channel contributions into those public pensions schemes, are really the way to go for this wide group of people. I'm also assuming that for the very poorest, we'd still continue to need and hopefully gradually expand as tax revenues allow a minimum safety net. So if we then say, turn back and say, so what does it take to get people to make contributions? We all know, all of us who work in financial inclusion know that there are some special challenges that relate to the way that low-income people, to their lives that would make it difficult. And the first of those is irregular income, with the fact that you cannot necessarily assume a specific inflow every month that can be tapped to make a regular contribution. So what do you do about the fact that income comes in at a variety of times, and there, so a pension product that's going to work needs to be able to allow some flexibility in terms of timing for contributions so that it's done when money is available. People also shift their sources of income. They may even be formally employed for a little while. Usually they're self-employed, and so the system needs to collect no matter where that person's income is coming from. So traditionally, the regular pension schemes have been anchored on employers, and while employers could still play a role in this, it's clear that pensions for this population need to be portable and move with the individual. Of course, the small transactions, so we need to be able to make it worthwhile to make those small payments, and one of the important things to do there, and it has to be worthwhile both for the customer to make the payment and for the financial institution to process the payment. And so one of the ways to do that is to piggyback that on top of other contributions that a person, or other payments that a person is making at the same time. Of course, we all are very aware that populations that are new to financial services have low trust in financial institutions. And that, I think I addressed that earlier by saying that I think that we really need to see the pensions going into a very, very stable and trusted source, such as government's long-term pension schemes. Language and literacy barriers require that any kind of introduction of a scheme needs a lot of hand-holding. And the fact that people are subject to frequent shocks in their lives is one of the ways that savings gets depleted. So there need to be barriers to depleting the pension funds for that reason, but at the same time, people do need to have access to some kind of emergency savings. So maybe there's a way for parallel products to go. And then they need the design needs to address a lot of the behavioral biases that we will that Susy is about to talk about. So I will just turn it to her, and she can talk about what those biases are and what the strategies are for overcoming them.
Mm-hmm. So thank you, Beth. That's a terrific overview. If we could move to the next slide. So as Beth said, one of the big issues is looking at the behavioral barriers to participating in pensions. And this is something that has become well known in the financial inclusion world as we've looked at how financial capability is an essential element of any financial inclusion strategy. The Center for Financial Inclusion put out a paper on this, a change in behavior, innovations, and financial capability. And many of these insights from that paper really hold true, and even more so for the pension inclusion world. So next slide, please. We're going to skip over this one in the interest of time, but you can enjoy this lovely woman with her goats. And let's go to the next one. Here are some proud goat owners. So this couple from India owns 37 goats, and this is their pension plan, their goats. Gautam mentioned earlier that children have been proven to be a poor plan for pensions. Traditionally, over millennia, children were expected to care for their parents when they got older, and that's not working so well anymore. But goats have been another strategy for pensions. And so we've talked about this often in the financial inclusion world. How can you build a better goat? So next slide. So how can pensions, in fact, be more like goats? So goats are a productive asset. They're tangible, easy to take care of. Everyone has one, so they're familiar. They're not scary. They don't get involved in scams. There's no inflation to deal with. They're trustworthy. What you see is what you get. And I'm sorry to mention this, but they can be sacrificed in an emergency. So moving on to the next slide. Beth talked about the issues of trust. In the paper that we just put out of the Center for Financial Inclusion with the Institute of International Finance on inclusive insurance, this issue of trust came up as one of the prime barriers for insurance, and it's also true with pensions. So I mentioned scams in the previous slide. So I'm a potential customer. I already don't trust banks. I already don't trust insurance companies. So why should I trust someone who says they will take my money and return it a few decades from now? That's a really bizarre proposition. So pension design has to prioritize issues that address these barriers of trust. Certainly building in consumer protection from the outset, transparency being one of the primary consumer protection principles that needs to be followed with pension design, and also building in assurances such as verification. This is the money you put in, this is what you have, and frequent reports back to the customers. Next slide. But even if you do trust the system, say all of those elements are in place, there are still a lot of reasons people do not save. And it's even more difficult for thinking very long-term savings, such as pensions. So our minds work, according to behavioral insights, in ways that bring us anxiety about aging, disability, and death. We value the present over the future, a behavioral principle called temporal discounting. We have executive function issues. We're overwhelmed by small hassles like paperwork, and we're really geared towards social and cultural norms. What do our neighbors do? All of those things lead us to wishful thinking, lack of action, paralysis. We prioritize liquidity and near-term returns We're forgetful, we don't have action plans, etc. And so these things, here's your head in the sand photo. These kinds of anxiety and lack of knowledge lead us to avoidance and inertia. So next slide. So there are some behavioral principles, behavioral insights that can help us with overcoming those kinds of anxiety-based and other challenges. So one of them, I won't go into all of them, but just very quickly, one of them is rules of thumb. So a problem with money and savings is that we can't really grasp the opportunity cost. We're giving up something today in the hopes that it will benefit us in the future, and how can we make that real? So rules of thumb can help with that. In the United States, there's this concept of the latte factor. So one $4 latte every day for 40 years, well, you look at the math, and with compound interest, it really adds up to a pretty generous income in your older age. Likewise, I know Gautam and his team have worked on the tea and tobacco factor, let's call it. If you forego 1 cup of tea and 2 cigarettes per day, this is working with construction workers in India that they looked at this, that can really generate a start on a good pension. So next slide. But the biggest behavioral tool that seems to have made an impact on pension uptake and really taking advantage of pension products is this concept of nudges, reminders, and defaults. A UK study of enrollment in defined benefit pension plans. Now, this is everyone's dream come true, to have a defined benefit pension plan, yet only half of eligible employees signed up, even when the plan was fully paid for by the employer and required no employee contribution. That's pretty staggering. Similar results have been found by Gautam and his team in Rajasthan, India, people who are capable of saving for retirement, but if there's not a default set up, less than 5% would actually sign up. Similar results in the US and other parts of the world. So this idea of creating something that's kind of a default option is really ideal. Alongside that, Dean Carlin and many others have done studies that show that SMS reminders really incentivize people to increase their savings. So, on the positive side of the giving the nudge, giving the reminder. So this is something where, as much as we could build these kinds of things into the design, we'll be much better off. Next slide. So these are elements of good design. We know this from financial inclusion, that consumer protection, financial capability, all of these things really need to be built into the design of products, and that those products need to be informed by behavioral insights. In the insurance paper that we just put out, simplicity was one of the #1 things in terms of really encouraging uptake so that people understand the product and know how to use it and what the benefit is to them. Convenience is another big thing. How can I make payments into a pension plan conveniently? That protections are built in, as I already referred to. There is also the concept in retirement planning of set it and forget it. So things become out of sight and out of mind, but in a good way. It's that you just set something in motion and then it continues carrying on, and you don't have to keep acting to keep it going. Likewise, for many of us in the financial inclusion world, bundling and cross-selling are something that we need to think about. How can pension inclusion be part of a suite or bouquet of services that are offered to customers? So wrapping up with the final slide. Next, thank you. So I would just put this out as a challenge for financial inclusion leaders. We have customers who are going to be growing old or are actually old. Dr. Kavim Bhatnagar introduced this concept of pensions for groups of poor women in India, and he really had a brilliant way in a very short obsession of taking them to the point where they could recognize their need for pensions and be motivated to do something about it. And it all started with this question: do you think you are going to become old one day? And I'm sorry to say that old was defined as age 60. I think of that as quite young at my age, but this concept of, do you think you're going to become old one day? And so here's how I'd like to introduce this concept of pensions to financial inclusion leaders. Do you think your savers, borrowers, policyholders, payments users, in other words, your customers, do you think they are going to become old one day? And if you think they are, what are you going to do about it? And so this is our challenge, to take these insights, these early experiments that Gautam and his team have done in actually making micro pensions available to people, and to take lessons that are very rich from the pension world and begin to apply them into our work in financial inclusion. Thank you. Oh, excuse me, before you shut off my mic, I just want to say there was a really interesting comment posted giving an example from MicroSave, and I don't think, it wasn't a question so much as a comment. I'd love to see that posted for everyone to see if it's not available, because it's a really good example of how this kind of thing can play out in the real world.
Yeah, and maybe we can reach out to him and ask to Khanna and ask whether you might be able to talk a little bit about that example when we turn to the discussion section. So so look for our message, Khanna, and we'll call on you for that. Thank you so much, Susy. I love that we've moved in the last 40 minutes from talking about the global need to looking at insights into pension design, building on work done across the financial inclusion world. Now we're going to turn to the question of what the implications of this discussion are looking to the future of pension inclusion. And to kick us off in this discussion, which I think will probably also carry over into our larger discussion, I'm going to turn to William Price. Will is a senior financial sector specialist at the World Bank. He focuses on pension system design, governance, regulation, and supervision to improve coverage of good quality pensions and increase assets to fund long-term investments. And boy, after hearing what we've heard in the last 40 minutes, I'm sure glad that there are people in the World Bank that are thinking about this and really focusing on it. Will's work ranges from leading country projects in all regions and doing research on regional and global issues. So Will, let me turn to you to hear your insights on what the implications are looking to the future of pension inclusion.
Thanks so much. Let me just check that you can hear me.
Yep, we can hear you just fine.
So let me be brief so there's time for questions. First of all, it's a pleasure to be on the call. And as the introduction said, the last 6 years I've been working in the World Bank, countries across the world on these kind of issues. And in a previous life, I worked at a finance ministry and as a financial regulator. And much of what we were thinking of in terms of the project that we're doing with Gautam, the book project, and our wider work is informed by those past roles as much as this current one. And realizing that when you come to design a pension system and you're thinking, how am I going to get people in? And you think a lot about pension design and investment strategy. Issues that we've kind of thought that were incidental in the past, like how do I find a person? How do they contribute? How do I do the accounts over time? Those issues which you think, oh, well, you know, they just get sorted. That's just the plumbing of the system. Actually were much more fundamental, and that if you couldn't sort out those issues, if you couldn't sort out the financial inclusion aspects, obviously in developing countries, but also developed countries, then really, you know, a lot of it was theoretical. You could have the world's greatest investment strategy, but if you don't have someone making contributions, then what does it matter? But the more we looked at it, and actually, if we can go 4 slides down, just for time, let me just go to a couple of slides. Another one. Yeah. So the more we thought about it, the more we thought of have to go back to first principles on how do you actually build a pension system and what is it? And so if you look at this diagram, it's the value chain of a pension system. And so you start off membership and payment channels. Who's going to do the record keeping and the account management? Who's going to do the governance and the investment, i.e. work out what's a good investment strategy for members? Who's going to execute that investment strategy, number 4, and then how do you pay it out? And in a lot of countries, particularly developing countries, all of those are done essentially by the same institution. You get vertically integrated often private insurers, and often well motivated, but the costs of doing all of that with multiple providers doing the whole value chain becomes prohibitive. And it turns out that, if you're going to get 4% real returns over time, but it's going to cost you 250 basis points a year to do all of those things, you might as well put your money in the bank or in a local local savings scheme. So if we go to the next slide, what we then said is, if you dematerialize that, if you take each part in turn, is there a better way of doing it, and what can we learn from global best practice? So the left-hand side in the red, whatever shape that is you need to have ubiquitous and low-cost access. So if you're relying on different companies with different sales agents going out, it's never enough money to justify them just selling a pension product. There's mis-selling scandals in pretty much every country I've ever looked at. So you've got to find a way that you could have multiple entry points. And the work we were doing with Gautam in India was basically piloting that you can use existing financial inclusion infrastructure to enroll people in a digital and paperless way at the village level. Reforms in Mexico show that you can hook up thousands of payments, from a 7-Eleven and other grocery stores, to be a way with just your ID number, you can automatically send money into your pension account. So if you can't find the income stream because there's no regular employer, if you're informal, you can find the payment stream. But it's all of those people who are good at getting people into a system, including self-help groups, microfinance groups, are not the people who should be administering an account over 40 years, because you want an account which starts in the village, can go to a formal sector job, go back to the informal sector, be out of the labour market for a while. So these people have very turbulent labour market histories. So you need accounts which will follow them, and that basically needs a national ID and a digital ID, and you can do that much more at scale. And then the investment side, you need to make sure that you do that at scale. And again, the people who are good at doing account management and the people who are good at doing payments are not typically the people who are good at doing investment management. And you can tender those investment management at scale for everyone. So rather than you having 10,000 people with $100 each trying to find an investment manager, the entire amount of money is done in one bid, and you get dramatically lower costs. And rather than the whole thing costing you 2.5% of assets under management a year, 250 basis points, it should be possible to do this for 50 basis points or even lower. And once you do that, you square this circle of putting your money away being a decent thing to do, because you'll get greater real returns. And it's and that is basically the entire issue, that you've squared a circle of the how do you get people into pensions couldn't be solved until you had the financial inclusion revolution. But the what a good pension looks like, too often we found in the financial inclusion literature, people just assumed it would be provided by a normal financial institution that was providing the bank account or insurance. And what's interesting is actually global best practice is not to have it done in that vertically integrated way. So let me stop there just so there's some time, and recommend people read the book, and Gautam can tell us when the electronic version is available.
Great. Well, let's go ahead and turn to, thank you so much, Will, for those thoughts looking at the bigger picture. And again, I'm so glad that you and others at the World Bank are focused on thinking systematically about this, because it's clear that it is a global concern, and this issue is going to only grow in its importance as we move forward. I'd love to turn first to Gerald. And while we open his line, I do let's just mute him for one second. I think, Gerald, there's a little bit of background noise. So while we get you, I do want to acknowledge we're almost at the top of the hour, recognizing the richness of this discussion that we've been having with our panelists today. We are going to keep the line open for maybe even up to half an hour past the hour. Certainly, we want to make space for discussion. We've had some really engaging questions coming in that questions drop down. So if you have a question and want your voice to be heard in the discussion as we move forward, please go ahead and either raise your hand or put a question in the drop down menu. We're going to turn first to Gerald, who's calling about Zimbabwe to ask about that specific country. And I'm going to put Gautam on the spot to answer Gerald's question. Recognizing that I don't think, Gautam, you currently have work in Zimbabwe, but I know that you tackle questions like this all the time. So, Gerald, let's go ahead and open the line to you. Gerald, are you there? I know we had you just a minute ago. Gerald, are you there? Can you test your test your mic here? All right. Well, we're gonna keep trying, but I'm gonna go ahead and take the initiative and read Gerald's question. So he says, "Good day. Zimbabwe has become more of an informal country, but with a high literacy ratio." And Gerald's observation is that people really need pension insurance. He recently wrote about it on LinkedIn, and Gerald, we can look that up from our end. But it seems like he hasn't been able to find great answers. He thinks that with new technology, it will be possible to link people who are in the informal sector who don't even have bank accounts and rely on irregular income to some sort of formalized pension cover. Gautam, when you hear questions like this from countries all over the world, how do you go about approaching them, and do you have any specific insight on Zimbabwe?
Thanks, Sonia. And thanks, Gerald, for the question. So I think if you really think about it, I think most of the questions, frankly, have already been answered by people who are leading the way on digital financial inclusion. So when we faced this problem, let's say with some tribal communities in India a few years ago, and we had the same problem. I mean, there was interest, but the savings values were very tiny, and we were terrified about the likely transaction costs if we use the traditional sales and distribution model of finance. So what we did was we simply worked with Visa in developing a prepaid card-based solution, which was then used by low-income people who did not have bank accounts or whose banks were too far away to really make sense, or and therefore were very inconvenient. So these guys were actually using prepaid cards to make regular pension contributions, and the prepaid cards worked in a very simple way. I mean, and there was the rocket science had been taken out of prepaid cards by Visa already. All we did was use the same solution that was being used by higher income workers in metro cities, and we simply said, what if we were to offer a prepaid card solution? And people were using these cards exactly how they would use prepaid phones. So they could walk up to a shop and put 10, 20 rupees into their prepaid cards, and when the money became equal to a contribution that they had committed, let's say 100 rupees a month, then the money was automatically pulled out of a prepaid card or from their prepaid wallet and directly sent to the fund manager. So I think there are technology solutions that already exist, and we're very happy to have a conversation with Gerald on how some of these things can be solved. But my sense is most of the challenges that he's facing or he thinks he's likely to face in Zimbabwe are challenges that are equally being faced in Tanzania or in Rwanda or Kenya or South Africa. And a lot of these countries have started doing very interesting things around using FI or DFI infrastructure for answering some of these questions. And we are very happy to point him out or to show him how some of these things can actually work.
Thanks so much, Gautam. Let's turn now to Khanna. Susy mentioned that MicroSave has some great examples of levers that can be employed to increase participation in pension schemes, and I wondered if I can turn to you, Khanna, to describe that initiative that MicroSave has. Khanna, can you test your microphone for us? Yep, we can hear you. Go ahead. Khanna, we can hear you, so you can go ahead and speak. Khanna, we're getting a bit of background noise. We've opened your line. Would you mind testing your mic again? Yeah. Well, I'm going to go ahead and read Khanna's comments because I do want to highlight this example. MicroSave did some qualitative research in a recent assessment on saving in old age schemes. They employed an innovative tool to stimulate discussion with participants, and they gave pictures to people to help understand people's expectations of old age living. So similar to what Susy mentioned, that question of do you expect to reach old age? So respondents were asked to describe how they imagine their old age and whether they could describe the lifestyle of any older people who they had looked up. And apparently this was very successful in increasing people's contribution to their pensions. So I love that example of thinking about how to use behavioral economics to nudge and remind and inform people to try to incentivize behavior change and action on increasing participation in pensions. I'd love to turn now to Rupal. Rupal sent in a really interesting questions on enrollment differences between defined benefit pensions and pensions without defined benefits. Rupal, could you test your sound? Are you still with us? Rupal, would you mind testing your microphone for us? We've unmuted you from our end, so if you are trying to speak right now, it might be that you are still muted on your device that you're calling in from. Well, apologies for these technical glitches, but I'm going to go ahead and just read this question. I think it's a really good one. So Rupal Kulkarni asks, do you see any difference in enrollments between defined benefit pensions and pensions without defined benefits? Is certainty of returns a significant determinant of enrollment? So I'm going to ask Will perhaps to respond to this. Will, you can go ahead and kick it to Gautam if you don't feel prepared to answer this question. I know I'm putting you on the spot here. Will?
Sure. So I think it kind of depends. So if you take the UK experience of auto enrollment, that was seeking to get people who are not sort of informal in the sense we're talking about in developing countries, but people who had no pension coverage, were low or middle income, often in high turnover jobs like catering and hotels and restaurants. And by automatically adding them in this case to a DC pension, more or less 90% of those people stayed in. Now, would they have preferred a defined benefit pension? Probably. But actually, if you offered them the defined contribution pension plus an employer contribution plus a government addition, then they stay in because with good communications at a simple level, people realize it's in their interests. That said, if you had a choice, typically people do prefer the certainty. So in the Indian case, the new NPS national pension system has a defined contribution option, but the government in 2015 introduced the APY plan, which effectively is a defined benefit because it has a return guarantee in it. So you could say at the point of enrollment, if you contribute 1,000 rupees a month or on average, and you can have variable contributions, you'll get X at retirement. So it's one of the things that could help recruitment, but on the other hand, it makes it much more difficult from a regulatory point of view. So I would always advise any country you should pilot it, and you should pilot the benefit structure as well as other issues before you go into the final design. And if the DB makes a massive difference, maybe go ahead with it. If it doesn't make a massive difference, then it's so much simpler to guarantee all the other aspects of a pension through defined contribution that I would probably err towards that point.
This is Beth, and I have a question that I'd like to ask to Will or Gautam, and it's the question about cashing out early. And what I see happening quite often, and as people have more and more control over or more responsibility for managing their own pension resources, one of the issues is early cash out. And especially here in the US, when people change jobs, they frequently want to cash out their lump sums that they built up in one job, and rather than rolling it over to another. What are the ways you see for dealing with that challenge?
Shall I start and then hand over to Gautam for both of them? So I'm not a big fan of cashing out because the thing is you can't spend the money twice. And so if you give people access to the pension for their house or for their education or for their health, all of those are very legitimate needs. But then it means often there's no money when they get to old age. And so if your policy objective is to get people to old age and have some assets behind them, it often is not a great, it's not great. And the US example is a good one because 40% of retirement saving contributions leak out due to those kind of things that Beth mentioned by the time of retirement, which for a country which is saving enough anyway is a massive sort of Achilles heel. That said, if you're asking people on relatively low income, and this is not for people on the lowest of incomes who are barely struggling to get by, this is for people who can save small amounts irregularly. If you're asking them to lock it away, that could stop them wanting to do it in a pension. So again, this is one for piloting and see how much of a difference it actually makes for your population in your country. And the other thing is, I quite like the Malaysian Singaporean model where what you have is basically two accounts. So you put all your money in and 70% of it is locked away forever until you retire. You can get access to 30% of it. And if you do something like that, you allow people the access, but only to a part of it. And you encourage this concept of long-term locking in. Because also from an investment point of view, if the money can constantly be withdrawn, you can't do a long-run investment strategy which can invest over sort of volatile investment cycles, which is usually the best way to get the best returns. So that's what I'd say, and then I'll hand over to Gautam.
Thanks, Will. I think Will has answered actually, a major part of this question, and Beth, this is it's actually a very, very important question, especially in countries in which we are working. We find that most people don't have, pension seems to be the largest pool of savings that they will accumulate. And when there is an emergency, the first intuition is that they want to withdraw some of this money. And I think that typically happens, as Will also correctly said, that partly it happens because you're allowed to withdraw the money. And if you're allowed to withdraw prematurely, people do tend to use that. But if you're not allowed to withdraw, it has an adverse impact where people then tend to stay away saying, I can't afford to lock in my savings. And the reason is, what if something goes wrong? And I think that's where, in fact, you and Susy brought this out very nicely in your paper, which is that if you go back to the fundamentals of why people tend to withdraw prematurely, and if you try and address that question, I think that could give you a better bang for the buck. So one of the challenges that most most of the people, let's say, that we deal with in developing countries, they face is that they face the same life cycle risks that all of us on this call face. But unfortunately, unlike us, they tend to use past savings to pay the cost of those emergencies or risks. Unlike us, where we use, let's say, medical insurance to pay for medical costs, or accident insurance for that, or some other insurances. Now, most of the people we're dealing with in the micro pension space don't have insurance, so they tend to use past savings, or when past savings are not enough, they tend to then go out and get some emergency credit, and when this is not sufficient, and this sort of puts them back and sort of wipes out past savings, and also wipes out their ability in the near future to set aside more savings because they're repaying some emergency loan. So I think the best way to handle this, as Will said, is to create an account which is bifurcated into two, which is one, some part of your long-term savings are actually going into a liquid account, and you can withdraw whenever you want. And it, I think, gives some sense of comfort. But equally, I think it is possible for people to say, instead of using savings, why don't you use well-designed insurance products? So, and that leads to what Susy had said, which is around bundling. And I think bundling then makes a lot of sense, where you are offering a pension program, but you're offering also some additional insurances which take care of the more near-term risks, or more near-term life cycle risks and emergencies, like crop failure, of a cattle dying, etc., etc., and which then makes sure that people don't have to go back to a pension program and demand their money back.
Thanks. I'd love to open the line to add to this discussion. I'd love to open the line to Caroline van Doeleman, founder and director of World Granny, because I know that she has some experience with this as well that I'd love for her to share. Caroline?
Hello, can everybody hear me?
Yep.
Yeah. Well, great for letting you share some of our ideas or some things we experienced in this field. We were talking about the split accounts, and also insurance was just mentioned. And a very important part of that is something we discovered about 2 years ago, working on our micropension designs, especially for clients in the Solomon Islands, is that the design of the product is much broader than just focusing on pensions, but that it's also good to focus on medium-term savings, on insurance, etc. And if you can make kind of a product suite, so to say, of a long-term savings product for your pension, and then have a 50 or 30% for special needs as savings, and in one of our products we have a special death benefit, and that's like an extra incentive clients just pay a very small premium for, and if something happens, they know their family will get a few $1,000s as payout. And we have learned in our sessions with clients in the field that combining these elements in a micropension product was really interesting for them, because it caters to several needs they have of managing their money as informal workers. So that's something I think is very interesting for everybody to take away.
Thanks so much, Caroline. I'd love to ask one final question. We've talked a lot about solutions to the problem of a lack of pension inclusion, and those solutions have ranged from behavior-based solutions, ones with nudges and reminders that sort of puts the burden and the solution on individual end users. And we've also talked about large systemic changes that need to be made. Susy, I would love to get your thoughts here on this question of the balance between building the financial capability of end users, but then also making sure to change systems. Can you talk a little bit about that balance? The easy answer is we have to do both, but I guess what comes first? What do you see as the big priorities in this space, Susy?
Yeah, that is a really tricky issue, and I think Bill had some interesting comments on that, and certainly the work that Gautam is doing is very much addressing that kind of question. As I was sharing my slide where I talked about some of the results about default options, I was realizing, yeah, that sounds really nice, because these people had actual employers who were giving them these retirement options, and even so, they weren't signing up. So what about the non-salaried workers and the people who don't have that benefit? So one thing I think is Will talked about different ways to make payments convenient, and this idea of enlisting this broader set of potential partners and distribution channels, retailers and others, where you can just make this kind of thing easy. This is something we also found in the insurance paper, is that the more venues, the more distribution channels, the better. And then this other idea of aggregators. How can we develop a broader set of aggregators beyond the traditional employer-based aggregator? How can we work through associations and through maybe having employers expand beyond their permanent employees to look at contract workers or people in the supply chain, for instance. So I think that there are, one of the things that really needs to happen is for governments and the private sector and all the different players to come together and recognize that this is a really vital issue, that everyone's getting older, the population globally is getting older, and as Gautam laid out in his opening slides, there really is going to be a very significant crisis coming forward if we don't address this now, and the time to start is now. And so it needs to be a conversation across all of these different stakeholders to address this and to build a cultural and societal expectation that facilitates everyone working together to plan for older age.
Thanks, Susy. I think that that's a really nice note to end on. We have a couple more questions. Thanks again to those of you who stayed on, and we are going to follow up with those questions by email after the webinar. Thanks again to each of our panelists, to Gautam, to Susy, to Beth, and to Will, for elucidating this issue for us. This is something that's not something I work with in my everyday, and it really motivates me personally. Thanks to all of you for joining us and to staying after. I'm just so surprised at how few people dropped off at the top of the hour, and I think that speaks to the importance of this issue and people recognizing that it's important.
Can I just add one thing? Is I have been referring people to the website for the book, and when I do, I can't find information on how to order the book. So if you can just quickly describe how to order the book, it would be very helpful, I think.
Gautam, can we turn to you for that?
Yeah. Thanks, Beth. We've been struggling with trying to put this in on Amazon, but what we are doing is we've spoken to the publishers, and both the e-version and the physical hard copy will be available in the coming week for anybody to subscribe. What I'm going to be doing is I'll share a link with Sonia and request her to circulate that link to the people who participated in this seminar. And we'll also put this link on our website, and it'll be great if we can request CFI to put a link on where the book is available on your website for a few days. It'll really help. I mean, you're really talking to the right community of people who might be seriously interested. So in the next week, you'll have the book available for a PDF download, as well as people who want to order physical copies can actually order those copies very easily. So, and this will be up in the next 1 week.
That's a great solution. We'll send out that link along with the recording of this session to everybody who joined and also everybody who registered, so that you can have the tools you need to share that with your network. Well, thanks again, everybody, for joining us for this webinar, Financial Inclusion and Pension Inclusion. We did put the link to the book in, or to the information on the book in the chat window here so that you have it right in front of you now. But we will be following up later with information on how to order that. We look forward to seeing you in our next webinar, and please feel free to be in touch with us if you have any questions or comments following this, and we'll be sure to be in dialogue with you. Thanks so much. Have a great morning, afternoon, or evening, wherever you are in the world.
Great. Thanks so much.
Thank you very much.
Thank you.